The broadcast is now starting. All attendees are in listen-only mode.
Hello and assalamu alaikum everyone. Thank you for joining today's webinar on Bridge the Gap, Financial Management to Advanced Financial Management. My name is Ahmed Bilal and I'm the Education Executive for ACCA Middle East. The ACCA Middle East team, in collaboration with our approved learning partners in the region, have come up with Bridge the Gap series. And today is the third session of the series. Today's session will be facilitated by Mr. Waleed Minhas from Kaplan Professional Middle East. He has extensive training experience in the region, focusing on financial management and management accounting. He was a lead trainer in his previous role at one of the Big Four firms, where he also managed professional qualifications degree programs and trained the trainer courses. Waleed brings more than 8 years of industry experience in the UK and UAE, where he has been involved in setting up and controlling finance functions of diverse businesses. Waleed's training approach is built around adding value on courses and incorporating memory and exam techniques to help students ace their exams. He has also trained many national, regional, and global prize winners and has helped candidates achieve exceptional pass rates. He was nominated for PQ Lecturer of the Year in 2021. Talking about today's session, the Advanced Financial Management exam at Strategic Professional follows on from the Financial Management exam at Applied Skills. The AFM exam builds upon the skills and knowledge examined in the Financial Management exam. At this stage, candidates will be expected to demonstrate an integrated knowledge of the subject and an ability to relate their technical understanding of the subject to issues of strategic importance to the organization. Also, the session will enable students sitting for the AFM exam in any of the upcoming exam sessions to bridge the gap between FM and AFM exams. Before I hand over to Waleed, there are some housekeeping rules. I would recommend all of you to attend the complete session to understand the full essence of the webinar. And you can type in your questions in the chat box, and we will be taking your questions towards the end of the session. Thank you so much. All over to you, Waleed.
Okay, thank you very much, Bilal, for this introduction. And hello, everyone, and welcome to this Bridge the Gap session on FM to AFM. And I'm really pleased to get this opportunity to work on this session in collaboration with ACCA Middle East. And I hope that this is useful for all of you attending the session today. So if I can just move through my slides first up, and I will be toggling between my slides, a question pack, and also a PDF where I will put some notes. So here's the agenda. I'll talk about myself, although Bilal has introduced everything. So I'll just briefly whiz through things. We'll talk about the gap, which is there from FM to AFM. And then at the end, we'll have a session of Q&A as well. But in the meantime, while I'm going through this session, if you got any questions you want to ask, please feel free to raise in the chat box. If I can pick it during the session, I'll pick it. Otherwise, we'll do it at the end. So just a quick one about me. So obviously, my name is Waleed, and I am currently head of exam prep at Kaplan Professional Middle East. I teach financial management and management accounting. In case you want to get in touch with me about anything related to financial management or management accounting or anything as part of your journey on ACCA, please feel free to get in touch on my email address there, which is waleed.minhas@kaplanme.com. So I'll also share this at the end of the session, that how you can get in touch with me. But if any one of you wants to make a note of my contact details, then it's here. So without wasting any time, let's get to the business end of things. Here's the gap. So what I've done is I've taken all the topics which are going to come into your AFM exam and which are mutually tested in the FM exam as well. And I've thought about what are the basic things that you need to get right before you start your AFM journey. The examining team on AFM talks about this gap as the first thing. So whenever they talk about AFM, the first thing they will say is that AFM is built on the knowledge which you gain in the financial management exam, and therefore all these topics which I've mentioned here are relevant for your AFM exam. So the skills of AFM, the challenges of AFM, you are going to study in your courses wherever you're studying, but in terms of the gap that arises, this session is going to be really useful in order to remember things that you would have done in the past or if you were exempt from the FM exam, then this session is so important for you to tell you what have you missed in FM, and which will be useful in your AFM. So talking about the gap, the first one which I see is in the basic financial maths. So when students start their journey in AFM, one of the things that really struggle with is how to compound, how to discount, dealing with annuities, dealing with perpetuities, and all those words that scare them, which should not, because they are really basic techniques of finance. So we'll recap on them. We'll talk about a basic NPV as well. I mean, depending on the time that we have, we can't do an extensive NPV, although I would love to do it, but we can do a basic NPV just to refresh our memories on it. We'll also talk about the weighted average cost of capital, and then we'll move into a bit of valuations, thinking about some of basic valuation techniques that you will need in your AFM exam, and then a bit of risk management, and finally some ratios. So we'll see how far we can get, but my aim is to touch on everything so that at the end of this 1 hour, you have enough content available or enough knowledge available out of the session that you can take in your AFM, but we need to be quick in terms of going through a lot of these topics. So the first thing is to talk about the basic financial maths and two terminologies which candidates will always remember from their FM journey, or if you're exempt, you would have done some other finance qualification, is compounding and discounting. The first thing is we have to be very, very clear. What does that mean? When we talk about compounding, compounding means that you have a present value given in today's time, and then you grow it into the future and find a future value. Discounting is the opposite, which means you have a future value given, and then you discount it in today's time to find the present value. So they are the opposites. So again, compounding is going into the future, and discounting is coming backwards into today's time from a future value. And obviously there are ways to do it. We'll then talk about annuities, which are a constant cash flow for a set time period. So if you have a constant cash flow for, let's say, $100 for like 10 years, that constant cash flow for like 10 years is your annuity. Obviously, it needs to be discounted. So we'll think of ways around that. And then finally, a perpetuity. A perpetuity is a cash flow forever. Perpetuity is a cash flow forever. And we will think of how to discount that as well, whether it starts now or whether it starts in future. So without wasting any time, let's go into ways of how we can compound and discount. So if I can just have a piece of this PDF annotator, and I can explain to you the ways to compound and discount. So the first one is compounding. And that's the most simple thing that you can ever do. And what you just need to do here is you need to take a present value into 1 plus the growth rate or the inflation rate to the power of n, and you find your future value. Remember the journey from present value to future value. So start from a present value into 1 plus the growth, or which could be an inflation. It could be just a rate of growth. It could be rate. It could be inflation. It could be interest. It could be anything. Yeah, the rate at which you grow it and you find a future value. Now, if you think about this and you think of discounting, it's the exact opposite. So in the discounting aspect, we are going to find the present value. Now, if that calculation on the screen is there, which is present value into 1 plus the growth to the power of n, equaling future value, and I have a future value given, but this time I want to find a present value, then that's a very simple calculation that we take a future value and divide it with 1 plus the rate to the power of n, and that's it. So that is how one is supposed to compound or discount the cash flows. That's a key skill that you need at this level going into your AFM journey. You should be comfortable with compounding cash flows and then discounting cash flows. Okay. Now, this bit obviously is also done for us in a PV table. So you are given a PV table in the exam, which all of us would have seen. So this one is without the table, but it's also given in the PV table, where you take future value into 1 plus the rate, that's N, and that is given in the table. The PV table, which is given to you in the exam, has got those discount factors computed, and there's no difference in them. So whether you want to do it the first way, which is simply taking a future value, dividing it with the 1 plus the rate to the power of N, so G or R would be the same thing, or you want to do it with the table, where you have a discount factor given in the table and you want to use that, it's perfectly okay. The only thing I would advise here is, please remember that when you are using the table, you always multiply with your future value. And when you're doing without the table, you always divide with your future value. Yeah, so hope that is something that you will do right. Okay. Now I've prepared a few questions here, and you will be getting a copy of these questions with this presentation, I assume, today. There are two questions here. The first one is compounding. So let's have a look at that. It says an investment of $500 is to be made today. That means today, means present value, in an account earning 5% interest. So that's your rate. Yeah, that's your rate, 5%. What will be the value of the account after 3 years? So what they're giving us is a present value, and they want to ask, or they want us to work out a future value. The rate is given, the number of years is also given. Yeah. So what we should do now is we should be looking to go on our spreadsheet. So I've just opened the test sheet, which is ACCA's testing platform. And I'm just going to work this out. So this is question number 1 that we're going to do here. Q1, which is compounding. And we are going to find the future value. Now remember what we all agreed. We all agreed that to find the future value, we'll take the present value into 1 plus the rate to the power of N. So let's go back to our spreadsheet. So we are going to look at the present value given, which is 500. The rate is 5%, and we want a rate or the future value for 3 years. So 500 into 1.05 to the power of 3. That's it. So I've taken a present value, I have compounded it for 3 years, and I will get a future value in 3 years' time, which is going to be $578. So that 500 is now compounded into the future. Okay, so that's really easy. If we look at the second one, which is an example of discounting, it now says there is a present value that we need to find, $65,000 receivable in 6 years' time. We have the future value, and the interest rate or the discount rate is 7%. The cash flow is given in 6 years' time. So what we'll do now is we'll take a 6-year cash flow, which is 65,000, and find its present value. Well, remember, how did we agree we're going to do it? Well, we can do it without the table. We'll take the future value, which is 65,000. We'll divide it with 1 plus the rate given to the power of number of years in which the cash flow is given, which is 6 years. So let's try that. Let's try the discounting bit. So this is Q2, and we are now doing discounting. Let's find the present value. Our cash flow that we are going to take is $65,000, and the rate is 1.07 to the power of 6. So 65,000, 1.07 to the power of 6. Done. So this means that we have discounted a future value to find a present value in today's time, and that present value comes out to be, 43312. It comes out to be 43312.24 as our present value. So the 65,000 discounted in today's time from the 6th year is 43,000 present value. Obviously, future values are going to be bigger because they're in the future, and the present values are going to be smaller because they are in today's time. Okay, so I hope that's fine. I hope we are fine with the compounding bits and we are fine with the discounting bits. Obviously, we can use a table as well. And on the table, we'll just take that cash flow into a discount factor, which is the easiest thing possible that we can do. Okay, so I hope that's fine. If there are any questions on it, you can put it into the chat box. You can put it at the end as well. So I'll take all those questions, or even after the session, you can get in touch with me if you have any questions to ask. Okay, so here is the first thing that we have done, which is the compounding and discounting. I hope that's fine. The second or the third thing here is the annuity. Constant cash flows for a set time period, and then perpetuities, which is a cash flow which can go on forever. Now, let's have a look at this. If I can go back to my question, here is an annuities question. It says a payment of 5,800 is to be made every year for 15 years. As soon as you see this, you see it's a constant cash flow. You see it's a constant cash flow, and you see it's for 15 years. So there's a constant cash flow for 15 years. It's an annuity. The first payment occurring in 1 year's time, so it starts from T1 and then goes to T15. It's an annuity. The interest rate is 12%. And again, for today, we can say this is interest rate, this is discount rate, this is cost of capital rate. It's 12%. So that means I need to discount this annuity at 12% for 15 years. Calculate the present value of this annuity. Now, the question is, how do you do this? Well, we're really blessed that we have an annuity table given in the exam, and we can use that annuity table to basically discount this cash flow for 15 years and find its value in today's time. So if I can just mention here, so to find the present value, we'll take this cash flow of 5,800. We'll multiply this with the annuity factor from 1 to 15, and that should give us a present value, whatever that value is. Yeah. So we'll just take that cash flow into annuity factor for 15 years at the rate of 12%. Okay. Now, if I can just quickly look out for a table. I'm sorry, I didn't open that table with me. If I can look out for an FM table, just give me a second. If I can just open my table to solve it. So here is my annuity table. It's here. So that will be given to you in the exam. Now, if I take the rate from this table, and the discount rate given here is 12%. So I've got a 12% rate here. So here it is, 12%. Taken that. And this annuity is for 15 years, which means the annuity factor is 6.811. So 6.811 is annuity factor. Let me take that 6.811 at 5,800. So let's do it here. Question 3, annuity. And we're going to find the present value, 5,800. And we have 6.811. And that gives us a present value of 39,503. So that 5,800 for 15 years, if you do a present value of that, that is 39,503 based on the annuity factor. Now, sometimes students ask me, well, how did they find that 6.811? How did they find that? Well, that 6.811 has been computed through this formula. There's a formula here. It's been computed through that formula. You can try that if you want to. The other way to think about it is that in the PV table, which is also given to you in the exam, in the PV table, if I take the rate, which is 12%, if I take 12% rate and I add all these discount factors, if I add all these discount factors, I should still get that 6.811. Yeah, I should get that 6.811 if I add all the present value factors. Don't try that. I mean, why would you do it when the table is given? But just for your understanding, I'm just making it clear that how that annuity factor of 6.811 has been computed. So the first way is through the formula, and the second way is by adding all the present value factors. You get that annuity factor of 6.811. Okay, so that's on the annuity. Now, one thing which I would like to add here is, and which comes up in the exam sometime in AFM, and it's a basic FM thing. Sometimes you have to deal with a delayed annuity as well. You have to deal with a delayed annuity. Now, imagine if I take this example of 5,800 payment, and I say that this 5,800, and let me just redefine that. So this is just an update to that question. 5,800, the rate is still 12%, but this time the timeline is from T3 to T6. So year 3, year 4, year 5, year 6. It's a 4 years annuity. This is a 4 years annuity. And I have to find the present value here. Now, there are different ways to deal with this. There are at least 3 ways I can think of how you can discount this annuity for 4 years and find the present value in today's time. But I'll show you the easiest way and the most quick way of doing this calculation. As you can see on the screen, that this is annuity for 4 years, which starts in year 3, year 4, year 5, year 6. Year 3, 4, 5, 6. I want you to go to the PV table, not the annuity table. Go to the PV table and take 12%. And within this 12%, now I want you to take those years in which the cash flow is occurring. And if I can take these days, these years, sorry, 3, 4, 5, 6. So I've taken all the PV factors in which that cash flow is supposed to occur, and I will add them. So 0.712, 0.712. So if I can go my spreadsheet, so let's say it's the discount factors from 3 to 6, and I'll take 0.712 plus 0.636 plus 0.567 plus 0.507. That's 4 years PV factors done, and that is the effective annuity factor to use now on your cash flow. So you take 5,800 your cash flow, multiply that with this 2.422, and your answer is done. And as I said, this is one of the 3 ways. There are other ways to deal with this as well, but I'm just thinking of the easiest possible way, which is to take the PV factors in the years in which the cash flow is occurring. And the cash flow is occurring in years 3, 4, 5, and 6. Yeah, so I hope that's easy for you. I hope you'll remember it. And this is how you deal with a delayed annuity. Okay, so to deal with a delayed annuity, I'll repeat again, 5,800, rate is 12%. The cash flow is occurring in years 3 to 6, which means it's not traditional T1. You take year 3, year 4, year 5, year 6, and then you discount it. Okay, so moving on to the next question, which is a perpetuity. A perpetuity is a cash flow forever. So perpetuity is a cash flow forever. And what we do here is we take the cash flows forever, and we have to find the present value. It's really easy to discount it, but it's not there in the tables. Nothing is given in the tables. There's a formula that you need to learn. The formula is cash flow divided by the rate. Cash flow divided by the rate done. There's nothing else. So you need to remember this formula, cash flow divided by the rate. Yeah, cash flow divided by the rate. So if I see this question, a payment of 5,800 is to be made every year for the foreseeable future. As soon as you see this word, it's in perpetuity. The first payment occurring in 1 year's time, and that means in 1 year's time, we have a payment of 5,800. The interest rate is 12%. That's the discount rate, and find the present value. So let's do it. Let's take it on our spreadsheet. So this is question number 4, which is a perpetuity. And I have a payment of 5,800 at 12%. So the present value is going to be simply taking 5,800 and dividing with 12%. And that's your present value. Yeah. And our present value is 48333. 48333. Yeah, that is the present value of this perpetuity, which is 5,800 forever, and that's it. So this is the first bit which students find really complicated moving into AFM. They forget how to do compounding, how to do discounting, how to deal with annuity, delayed annuities, and the perpetuity as well. So I hope that this was useful. I hope that you've been able to grasp what is here in terms of the basic financial maths, which is compounding, discounting, annuity, perpetuity. And as I said earlier, if we had more time, I mean, I wish I could stay here with you forever, but we have got limited time. And in the limited time, I can only cover certain aspects, but these are the more important things for me, which you'll need for your AFM journey, okay? But if there's any way I can help after this session, please feel free to get in touch. I'm very happy to answer any kind of questions you may have in terms of your basic revision of AFM, which you need for AFM. Okay, so that's basic financial maths. Moving on to the second gap, which is investment appraisal. Now, for some reason, we just forget NPVs. So the most important thing that you need to remember for your NPV is that you need to remember that what were the relevant cash flows. The relevant cash flows are those cash flows which are future, which are incremental, and they may include opportunity cash flows as well. Future, incremental, opportunity cash flows. So all the cash flows that you will see in NPV will be the relevant cash flows. So everything will be in the future. Everything will be incremental. And the word incremental means that they will be caused by the project, any cash flow caused by the project. For example, I'm doing the project and I rent some premises. Now, if I rent that premises for the project, then it's an incremental cost. Therefore, it's an incremental cash flow. It's caused by the project. And they may include opportunity cash flows as well. Now, the idea of opportunity cash flows is this. If I'm doing this project, I'm missing out on something else. What is that something else that I've missed out? It could be a revenue, or it could be a kind of a benefit. It could be a cost. Yeah. So future, incremental, and opportunity cash flows are what relevant cash flows are built up on. Now, what we will do is we'll take these relevant cash flows in our NPV and then discount these relevant cash flows to find a worth of a project in today's time. We'll take all the cash flows of a project, discount them in today's time, but make sure these cash flows are relevant. Future, incremental, may include opportunity cash flows. Okay, so let's try and do that. Let's try and recap through some numbers that what we would do on an NPV. So here is a sample question for NPV. It says calculate NPV of the project at a discount rate of 10%. So discount rate is given 10%. A project has the following information. The first one is purchase of asset at the start of the project is 120,000. Now this is a relevant cash flow because it is being caused by the project, and this will be at the start of the project at T0, and it's an investment. So this is investment at T0. The sale of the asset at the end of the project is $25,000. So whenever the project ends, it has a scrap value, and that scrap value is $25,000. Depreciation per each year of the 5-year project is $19,000. Interesting. Depreciation is not a cash flow. And if depreciation is not a cash flow, then it should not come in my NPV. Therefore, ignore it. So ignore, as it is not a cash flow. Interesting point here is that although depreciation is ignored, but if there was any tax saving on depreciation, that's relevant. Yeah, so depreciation is not relevant, but if any tax saving was there, then it should have been relevant. Then it says contribution per year for $40,000, and this will be from T1 to T5 as the project's time period is 5 years. Incremental fixed costs are $10,000, and that's also from per year from T1 to T5. So that's a very basic sort of a data given here to do this NPV. So if I can just put this into my software, so test reach question 5. And by the way, if you've never used test reach before, and sometimes I get AC students who never heard about it, well, please do. It's the best thing ever. So this is a software designed by ACCA to help you ace your computer-based exams. So question 5, it's NPV. And I'm just going to put the data first in terms of what is available. So here is T0, T1, T2, T3, T4, T5. So I've got 5 years worth of data. The first thing I have, which I will put now, is my investment. That investment is 120,000. And I know that investment will come at T0. So we've got a T0 investment of 120,000. I'll just zoom in if that's still fine. Yeah, that's better. 120,000 investment. Then I have also the sale value of the project at the end of year 5, 25,000. So here is the scrap value, which is $25,000. Then we have the depreciation, which we said we will ignore because it's not a cash flow. Contribution is $40,000. So let's put in contribution. And what is contribution? Sales minus the variable cost. Sales minus the variable cost, 40,000. So let's take that, 40,000. I can just copy it into all the remaining years. And then I also have some costs which are incremental, and the costs are the costs are $10,000. So negative 10,000. That's your cost. Done. So all my data is now ready in this NPV, which is a very short NPV. But what I will do now is I will take a sum of all these. So that is called a free cash flow. So I can have the free cash flows, which is basically the sum from B22 to B25. So that's the sum from B22 to B25. And I will just drag this forward. So I hope this is useful in learning some CB exam techniques as well, this session. And here is all my free cash flows done. The only thing I would do here is trying to beautify it a little. Just bring it everything in the center. You can use a separator as well if you want. And these are my free cash flows now ready for discounting. Now my discount rate in the question is 10%. Now you can either put the present value factors and then find the present values, but what I like doing is the NPV function. And now that Strategic Professional and AFM is a CB exam, so you can use the NPV function in the AFM exam as well. So let's try and use that. So let's find NPV at 10%. Let's find NPV at 10%. So let's do NPV function. Define the discount rate, which is 10%. Yeah, define the discount rate, which is 10%. Take all the cash flows that you want to discount. And those cash flows are from C26 to G26. These are the ones we want to discount because they are in the future from year 1 to 5. And then add the investment separately. And the investment was in B26. That's it. So if you've never seen NPV function before, this is gold. So you take equal NPV, open the bracket, put 10% as the discount rate, take all the cash flows that you want to discount, and then add the investment separately. And this should give you an NPV for this data, rather than putting in the PV factors and then finding the NPV through the tables, which could be more time consuming. Okay, so here it is. If I can just put it in decent numbers, here it is. 9246 is the NPV, positive. And whenever you have this, please make a comment as well saying that as this NPV is positive, shareholders' wealth will rise, therefore accept the project. And that's it. Yeah, so that gives you all the marks for that NPV. So I hope that's useful in terms of doing the numbers, using the function, and then putting a comment. But please, in this comment, just don't say accept or reject. Say that it's positive, shareholders' wealth will rise or fall, and therefore we are accepting the project or rejecting the project. Okay. Now, another thing which I would just like to mention here, when we talk about NPV, sometimes students say, well, there are so many things in NPV, we don't remember everything. Well, I've got an easier way for you. If you have to find free cash flows for any project, I have a memory aid which I can share with you, which is Otis W. Yeah, this has got nothing to do with me. Yeah, it's just a memory aid, Otis W. Yeah, it's not Otis Walid, it's Otis W. And what Otis W is that we look at O being the operating profit, T as the tax paid, the other T is the tax saved on depreciation. Obviously, in our little example, we did not have all these things, but just imagining a bigger scenario, you will have these things: operating profit, tax paid, tax saved on depreciation. You've got investments, you've got scrap value, and you've got working capital. And that should give you a free cash flow line, which you then discount using the NPV function. Okay, so that's a good memory aid for all your Otis W for your free cash flow calculation. So I hope that's useful. Okay. Now, if I can go back to my slides. So we're done with NPV. Let's just quickly move on and talk about cost of capital. Now, talking about cost of capital, first thing is you have to understand the WACC. What is the WACC all about? I'll talk about it. I'll briefly talk about how to find VE and the VDs. I'll briefly talk about how to find KE and the KD, and then we'll briefly work on a question where we'll find the WACC. Yeah, but I'm just allocating about 10 or so minutes for this maximum, so we'll need to be a little quick, okay? So if I can go to my PDF, and I would just like to create something here on the WACC. So here is the WACC formula, which is value of equity plus value of debt into cost of equity, VD, VE plus VD into KD1 minus the T. So here's the WACC formula in front of you. And if I can talk about these symbols, and if you've never seen these symbols before, which is possible, then this is value of equity. Value of equity. This is value of debt. This is cost of equity. And this is cost of debt. Now, sometimes students look at this formula and say, oh my God, this is such a bad formula, but it's not really bad formula. You need to understand it better. Now, if you have to understand this formula, what we say here is, if you work this thing highlighted on your calculator, this gives you the percentage of equity in the capital structure. This is the percentage of equity in the capital structure. And on this percentage of equity, you multiply it with the cost of equity. So percentage of equity into its cost. On the other side, we have this calculation, which is percentage of debt. So VD divided by VE plus VD is the percentage of debt, and percentage of debt into its cost. So if I can simplify this concept, the concept is that you take percentage of capital into its cost. And that's what the WACC is all about. So if you have 2, 3, 4, 5, 6 sources of finance and they are long term, then you find the percentage of capital that you're using and multiply it with its cost. And that's it. This is a very simple concept on the WACC. What we need to now look at is very quickly look at the ways in which we can compute these values. Okay, so if I can just mention those ways here. First of all, let's work out the value of the equity. Value of the equity. To find the market value of the equity, you take the number of shares and you multiply it with the share price. number of shares into the share price. That's it. Sometimes those number of shares are not given to you in the exam, and if they're not given, then what you do is you take the share capital and divide it with the par value. You take a share capital and divide it with the par value. Okay, so number of shares into the share price, you take the share capital, divide it with the par value. That gives you the number of shares. If you have to find the value of the debt, the VD, and you're working out the market value of the debt, is the long-term debt or the units of the debt, units or the number of debt into its market price. Now, if the units of the debt are not given, then you can take the long-term debt. You can take the long-term debt in the numerator and divide it with the par value of debt, which is normally $100. And that's it. So if you look at both these calculations, they are identical. So market value of equity, number of shares into share price, market value of debt, number or units of debt into its market price. And then you may need to remember how to find them. So I've broken those calculations down if you have to find those numbers. Okay, so that's on the value of equity in debt. So we're okay with the WACC. It is simply percentage of capital into its cost. We are okay with the value of equity, which is market value of equity in debt. And now let's just quickly look at ways how you can find the KE and the KD 1 minus the T. So cost of equity, which is the KE. There are two ways in your FM exam to find the cost of equity. So when you reach AFM, it becomes 3 ways, but in your FM exam, there are 2 ways. And the first way is CAPM. And the second way is using the growth model. Now, CAPM is KE is equal to RF plus RM minus RF into the beta equity. Yeah, so we can't go very deep into this point. I would have loved to talk about systematic risk, unsystematic risk, risk-free rate, but this is supposed to be a bridge the gap series, which means it should bring back memories of your CAPM calculations earlier. So risk-free rate plus RM minus RF into the beta equity. If it's a growth model, then the KE is D naught 1 plus the G, P naught plus the G. So these are the 2 ways in which you can find KE in FM, and these 2 ways still apply in AFM. They are perfectly okay to use in AFM. It's just that there will be one additional way to find it in terms of your AFM techniques. Okay, so that's your KE and the growth model calculation. When we look at the cost of debt, and we look at the cost of debt, which is KD1 minus the T. The way that we are going to use in AFM that you're going to use is from your FM knowledge. From your FM knowledge, if it's redeemable debt, we use the IRR approach. If it's redeemable debt, we use the IRR approach. Yeah, and with the spreadsheets now, it's really, really easy. So I'm just going to focus on the redeemable debt only because of the less time. So if I say that we have a redeemable debt, so let's just work it here, redeemable debt. And that redeemable debt, that redeemable debt has got some cash flows, T0, T1, T2, T3, T4. Let's say it has a market price of, I don't know, 103. It has a coupon of $6, and it is redeemable at par. So it has got a coupon of $6 in year 1, 2, 3, and 4, and then it is redeemable at par in the last year. Now, this is the cash flow of the debt, which is T0 market price, T1, T2, T3, T4, and then in T4 you have a redemption value. If you want to remember these cash flows, I've got a memory aid here which I call MIR, market price, interest, and then the redemption value, MIR. Now, if you have to find IRR on these cash flows, so IRR, KD1 minus the T, imagining this is post-tax coupon, we say equal to IRR, and take all the cash flows on which you want to find the IRR. All the cash flows. IRR, take all the cash flows. And that's your IRR, which is just a made-up thing here, 5.15. So 5.15 is my IRR, considering these are the cash flows. So what you need to remember, three things: market price, interest, redemption value. And when you have these three things, you can run an IRR calculation, and that gives you the KD1 minus the T. So there's no need of that formula now, which was the lower rate, the higher rate, NPV at low rate, NPV at high rate. Through the spreadsheets, you can just use that now. Okay, so I hope that is useful. And once you know how to find KD1 minus T, you know how to find the cost of equity, you know how to find value of equity and debt, then just a matter of putting everything into the WACC calculation and finding the WACC. Okay, so on this question sheet, I have left a question here, which at this point would be difficult for me to manage in the session, but I'm happy to share my answers with you on this question. This is a question which will take you through value of equity, value of debt, cost of equity, cost of debt, and then putting everything into the WACC and then solving it. So I'll leave that question there for your practice. But once you know how to work out the four things that we have just thought about in our PDF now, we should be fine with working out that WACC using this technique. Okay, so if I can now go back quickly to my slideshow. We have valuations as well. And there are three valuation techniques that will come from FM, which are net assets, DVM, and PE method. So we'll just briefly talk about them so it refreshes your memory. And I will also tell you how to do the debt valuation. Okay, so we'll talk about net assets, DVM, PE, and we'll talk about the debt valuation, just to do a quick recap of the valuations from FM to AFM. So let's go back to our PDF. Let's look at the three equity valuation techniques. The first one is net assets. And to be honest, net assets is simply total assets minus total liabilities. There's nothing else here. So you take the net assets of a business, and that is your value of the equity. Total assets minus the total liabilities. So that's it, nothing else. The second way is DVM. And we love this DVM because it's given on the formula sheet. So if you look at the formula sheet, the P naught, D naught, 1 plus the G over KE minus the G. This is the DVM given on the formula sheet. So using this, you can find the per share value of equity, dividends, growth, cost of equity. Once you have these three things, you can find the per share value. And the final thing there is the PE method. And when we look at the PE method, it is value of equity is equal to profit after tax into a PE ratio. The classic mistake which students do in the exam is they forget that they have to use post-tax profits. So PAT into the PE ratio. So the first technique, net assets, easy. DVM, super easy, given in the formula sheet. Third one, so easy. Profit after tax into the PE ratio gives the value of the equity. Okay. Now, when you look at debt valuation, and you want to find market price of debt, basically you discount future cash flows of debt. At KD. That's it. So if you know this, if you can remember this, that's perfect. Discounting future cash flows of debt at KD. Discounting future cash flows of debt at KD. Let's have a look at our last question for this session. And I have already put that question here, which is on debt valuation. It says a company has issued 8% redeemable loan note with 7 years to redemption. So if it's 8%, that means the interest is $8 from year 1 to year 7, which will be at nominal value. So it will be redeemed at the nominal value, which is 100. Investors require a return of 12%. That's your KD. And it says find the market price of this loan note. That is such an easy calculation. Let's do it on a spreadsheet quickly. So if I can have a look at question number 7, which is our last question for this session. Oops, sorry. So here is my cash flows. We have the years, we have the cash flows, we have the discount rate, which is given here as 12%, and we can have our present values. Now from year 1 to year 7, you have the interest, which is $8, and in year 7, you have the redemption value, which is 100. Now the only thing that you have to do here is you have to put your factors and discount it. So at 12%, annuity for 7 years. 12% annuity for 7 years. Here it is. 12% annuity for 7 years, 4.564. So 4.564. 12% year 7 discount factor. 12% year 7 is 0.452. And then let's discount it. So this value into this value, copy this here, and then take a sum of both these, which means the market price of this debt is 81.71, which means the debt is trading at a discount. And why was that? Because the KD was more than the coupon. And when the KD is more than the coupon, which is KD at 12%, is more than the coupon of $8, the debt is trading at a discount. Now I'll just put that there. It's an important point for you, I think. So KD is greater than the coupon. The debt will be at a discount. If the KD is less than coupon, then the debt will be trading at a premium, which means the market price will be more than 100. Now, market price more than 100 is obviously a very, very common scenario, which means that you lend someone 100, they pay you something more than 100, which means the debt is trading at a premium. The discount one is rare, which is a scenario where you give $100 to someone and they give you lesser value back. So in this example, you give someone 100, the rate is 8%, but they will only give you 81 based on the market price. Well, that's a very rare scenario. Okay, so I hope that works well in terms of your quick recap of the debt valuation. The last slide which I have here is my risk management. The only two things I wanted to cover here was forwards, and forwards are a fixed rate which is agreed for a transaction in future. The examining team will give you the forward rates. The only thing is that you need to use those forward rates to convert your transactions. They give certainty in planning. The other thing is to understand the rates. Please ensure that you remember how the rates are quoted. Are the rates quoted as home FX or are the rates quoted as FX home? That's really, really important, because then you know if you have to divide or multiply. Okay, so the last quick thing which I will do here is on the rates. So if I can go back to my PDF so that it gives you a bit of time to ask questions as well. So the rates, let's say as an example, the rate of exchange is $1.5 per the pound, and my transaction is $100. And let me tell you that dollar is your foreign currency and pound is your home currency. So dollar is the foreign currency and pound is the home currency. Okay, now if these are quoted as FX/home, and I can see here that my rates are quoted as FX/home, FX on the left side, home on the right side, then that means I have to divide, which means taking 100 divided by 1.5, that should give you the answer. If this rate was quoted as home FX, then you always multiply. This is a quick memory aid for you to remember that. Always remember, if the rates are given to you in FX home format, which is this format, FX on left side, home on right side, we always divide with the rates, and that means you get your home answer by taking 100 divided by 1.5. And of course, if this was home FX, then you multiply with the rates. Okay, so that's a bit very brief on risk management. And as I said, I wish I had more time to spend with you, but that is what we have. I've also put here a bit of ratios from your FM to AFM. So once you have this slide given to you, then you can look at all the key ratios which you can use as a student, which will be very useful in terms of your AFM. So just take these ratios from here, learn them, and use them to produce the answers. So I'm almost done with my time, and I've done my best in the 1 hour that I had to go through investment appraisal, business finance, go through a bit of valuation, risk management, and also covering a bit of ratios. So I would now ask you for any questions if you may have, so we can have a Q&A session at this point. So any questions that you may have on stuff, I'm happy to let you ask. So Ahmed, can we take any questions?
Absolutely. First of all, thank you so much, Waleed, for such a comprehensive session. So we have a couple of questions. I will put it to you, the way they've been asked. So the first question is from Hassan. He's asking, what is the easiest, fastest way to pass AFM first time?
Okay. The fastest way to pass FM first time is that you ensure that you do enough question practice. And my mantra of the question practice is that I would take about 20 to 25 most important section C questions. I would look at section A and section B, and I think you should have enough question practice of about 100 OT questions on each side, at least. That's the fastest. Okay, so have regular question practice and take key questions. So wherever you're studying, whoever is your expert tutor, ask your expert tutor for the most important questions so that you're directed towards that. But that doesn't mean that you skip things. It just means that you cover all the topics, but then more focused on the right kind of questions. So about 20 section C questions, section A and B about 100 OT questions. I hope that answers the question.
So actually the session is around AFM, how your FM knowledge can be utilized to to pass AFM, but we have some questions with regards to FM. So Ibrahim asked, is it okay to combine the FM paper with audit and assurance or any other paper? I mean, what would you recommend as a good combination with FM?
I think it can be done. I think that there's nothing stopping you from taking FM and let's say an audit paper. FM is about 50% discursive, 50% numbers. Audit will be more discursive. So that's a nice balance you can think of. So, but absolutely, you can take something else with FM.
Thank you, Waleed. The next question is from Asma. She's asking, can we use shortcuts in exams like SH instead of shareholder?
Absolutely. So whatever I've written here on the screen is acceptable by the examining teams. So you can say SH as shareholders wealth, SH wealth. That's perfectly acceptable. The examining team understands that what you're trying. So don't make shortcuts on everything that is there. The more obvious ones are okay, like SH is shareholders, interest is INTS. That's perfect. That's acceptable.
Thank you. And there's another question from Asma. She's asking, instead of using Excel formulas, can we just calculate and type?
No, because what will happen then is that if you will calculate on a calculator and then bring your answer on the spreadsheet or the worksheet, the examining team cannot see how you've computed the numbers. So they want to see it. And that's why I did it on Test Reach, which is AC's platform, to show you some functions that can work. And it's not difficult. Once you get used to it, it's perfectly okay. But you have to show how you've arrived at a number. If you don't show it on the spreadsheet, then the markers don't know how you computed that. So if there are step marks, you will not get those step marks then because they don't know how you arrived at that answer.
Right, thank you. Guys, if you have any further questions with regards to advanced financial management, I'll give you another 30 seconds because, okay, any quick tips to for success in AFM? I think Ibrahim has, Walid has already covered that. But still, if you have any further suggestions or tips.
I would just say on AFM, please be very, very prepared on your FM knowledge, because a lot of FM comes into AFM, and then AFM obviously is a different beast. It's a much more strategic, much more higher level paper in option papers. So once you are covered with the basic parts, then you can go on and take challenges of AFM, which are different sort of challenges. But first thing I would say is the most important tip is be comfortable with FM, because then a lot of FM will help you in your AFM journey.
Thank you, Walid. So at the moment, since there are no more questions, I would like to take this opportunity to thank Walid and the Kaplan team for today's session. And along with that, I would like to let you know that 2nd of August is the deadline to enter for your, or to avail standard exam entry deadline for September. So if you haven't entered for your exam yet, please make sure that you enter before that. So thank you so much, and please stay safe and good luck. Thank you, Walid.
Thank you.
Thank you.
You're welcome.
Bye-bye.